wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 180, and in this episode we are reviewing the performance of the financial markets during the 40th week of 2025, and that is from Monday the 29th of September to Friday the 3rd of October. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where, being as it was the first Friday of the month, we were expecting the Bureau of Labor Statistics to release the latest employment report, that is the Nonfarm payrolls for the month of September. However, to my surprise, following the government shutdown in Washington, the Bureau of Labor Statistics was unable to release its monthly employment report. This is the first government shutdown since late 2018, but the last time that the Nonfarm payrolls report was delayed was way back in 2013. However, other reports outside the government data suggest that the labor market continued to plod along in the month of September as employment growth remains anemic. And according to the Dow Jones Consensus Forecast, the U.S. labor market was expected to have created about 51,000 jobs in non-farm payrolls, with the unemployment rate holding steady at 4.3%. In the absence of the non-farm payrolls report, the ADP private payrolls report, which came out on Wednesday, took on added significance as the markets look for data to confirm whether the Federal Reserve is still on track for another 2 rate cuts before the end of this year. According to the ADP report, private payrolls saw their biggest decline in 2.5 years during the month of September, which was an additional signal of labor market weakness that further compounds the data blackout accompanying the U.S. government shutdown. The report showed that private companies shed a seasonally adjusted 32,000 jobs in September, which was the biggest decline since March 2023 and was a far cry from an economist survey which had projected an increase of 45,000 new jobs in the private sector. Over to the Eurozone, where inflation accelerated in the month of September, driven up by the cost of services and a minimal decline in energy prices, which reinforces expectations that the European Central Bank will keep its policy rate on hold for the time being. Inflation in the 20-nation member group picked up from 2% in August to 2.2% in September and came out in line with market expectations. Despite a pickup in services inflation, data from Eurostat showed that the more closely watched core inflation number, which excludes volatile food and energy prices, this held steady at 2.3%. Although the European Central Bank has spent the past 4 years battling excessive inflation, this recent uptick in inflation is unlikely to fuel too much concern amongst policymakers, as broader economic trends suggest that this is a temporary blip and inflation could soon be heading back down towards the central bank's target rate of 2%. On Wall Street this past week, the S&P 500 retreated from a record high on Friday but held on to solid weekly gains despite the U.S. government shutdown dragging on for a third day. Stocks were knocked down a bit in afternoon trading following declines in key technology names such as Palantir Technologies, Tesla, and Nvidia. Investors have been overlooking the concerns surrounding the government shutdown, mainly based on the expectation that it will be short-lived with limited negative impact to the U.S. economy. Despite the correction on Friday, the three major indices still recorded a positive close to the week, with the broad market index, that is the S&P 500, rising by around 1.1% during the week before coming to a close at 6,715. Meanwhile, the tech-heavy Nasdaq Composite increased by 1.3% before settling at 22,780, and the Dow Jones Industrial Average was up by more than 1% to finish the week at 46,758. In the government bond market, despite the government shutdown and the ensuing blackout on key economic data like Nonfarm payrolls, U.S. Treasury yields were still higher on Friday as investors weighed its potential impact on the U.S. economy. Based on previous government shutdowns, investors are predicting that this current shutdown may drag on for at least 2 weeks, which in their view will not be detrimental to the U.S. economy. Meanwhile, the shutdown has resulted in an economic data blackout, including the absence of key data such as September's non-farm payrolls report. This basically means that the Federal Reserve will have less economic data to influence its next monetary policy decision in the month of October. In response, the yield on the benchmark 10-year Treasury bond was up by more than 2 basis points to settle at 4.11%, as was the yield on the 2-year Treasury note, which also rose by 2 basis points to close the week at 3.57%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil edged higher on Friday, but was still headed for a weekly loss of about 7% after news of a potential increase in supply from OPEC and its allies. 8 members of OPEC Plus are meeting on Sunday and could agree to raise production in November by up to 411,000 barrels per day, which is 3 times higher than the October increase, as Saudi Arabia seeks to reclaim its market share. According to commodity traders, the probability of higher supplies from OPEC Plus, coupled with a seasonal dip in global demand, this is likely to weigh down on market sentiment and prices. For the week, the price of Brent crude was down by 7.7% before coming to a close at $64.63 a barrel, Whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this declined by 6.9% and was on track to end the week at $61.04 per barrel. In the precious metals market, the price of gold was hovering near record highs and was heading for a seventh consecutive week of gains, supported mainly by growing concerns about the economic impact of a prolonged U.S. government shutdown and expectations of further rate cuts by the Federal Reserve. According to CME Group's FedWatch tool, futures traders are pricing in a 97% probability for a 25 basis point rate reduction in October and an 85% likelihood for another rate cut in December. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. The price of gold rose by about 3% this past week and has risen more than 47% so far this year as it hit another record high of 3,896 on Thursday before eventually coming to a close on Friday at $3,884 per ounce. In the cryptocurrency market, Bitcoin rallied on Friday to within striking distance of its record high as the U.S. government shutdown entered its third day. Investors are now flocking to decentralized assets after U.S. lawmakers failed to strike a deal on federal funding that forced the U.S. government to shut down on Wednesday. Traders are turning to crypto and other safe haven assets in order to hedge against the risk of mounting political and economic tensions. In response to the foregoing, the flagship cryptocurrency recorded a massive surge of 12% this past week and was just about 1% below its all-time high, which is just north of $124,000, and was last seen trading at around $123,800 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where headline inflation increased marginally from 4.5% in August to 4.6% in September 2025, largely on account of higher non-core inflation. Non-core inflation, which consists mainly of volatile food and energy prices, this increased from 9.2% in August to 9.6% in September and was mainly driven by higher prices of select vegetable items. Meanwhile, core inflation, which conversely excludes food and energy prices, this decreased from 3% in August to 2.9% in September. All in all, inflation expectations remain well anchored as inflation continues to trend below the central bank's midpoint target range for inflation. And on economic growth, Kenya's economy expanded by 5% in the second quarter of 2025 compared to a growth rate of 4.6% for a similar period in 2024. This growth was mainly driven by a rebound in construction activity and a strong performance in the agricultural and financial sectors. The report from the Kenya National Bureau of Statistics on the country's total economic output shows that growth in construction helped to stimulate the economy, which also benefited from lower interest rates and a stable foreign exchange rate. Although agriculture registered a slower growth of 4.4% in the second quarter of 2025, it still remains a major driver of the economy as it contributes about 20% to the country's gross domestic product. Over to the domestic foreign exchange market, where the Kenya shilling continued to trade sideways as it reverted back to its favorite fixed spot versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24. Meanwhile, the sterling pound was priced at 174.76 and the euro was valued at 151.93. And on the regional front, one Kenyan shilling was changing hands for 26.77 Ugandan shillings and 19.03 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.23. Despite the central bank operating a floating exchange rate policy, the dollar-shilling exchange rate has been staggered between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined marginally by just $18 million for a grand total of $10.71 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. However, despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and remained well-funded with the support of the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate ticked up by 3 basis points to 9.51% and was pretty much in line with the central bank rate at 9.50%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 5.4 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 2nd of October, and the Central Bank of Kenya received bids totaling to 15.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 63%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate ticked up by about 1 basis point to settle at 7.92%, whilst the 182-day rate was stable at 7.98%, and the 364-day rate was a tad bit higher at 9.54%. In the equities market, shares at the Nairobi Securities Exchange provided the highest returns in the third quarter of this year, outperforming bonds and money market funds whose returns continued to decline as interest rates continued to fall. During the 3 months to September, investor wealth at the exchange rose by about 15%, which is equivalent to 367 billion shillings, as the total market capitalization reached 2.78 trillion shillings. The surge in the stock market was driven by renewed demand from foreign investors, as well as increased participation by domestic investors who were following the upward trend in share prices. Amongst the traditional asset classes, stocks offered the highest returns, with bonds coming in second with an annualized return of between 12 to 14%, specifically for new issues that were floated between July and September this year. Up next is our topical issue, and this week we're looking at the early buyback of the $1 billion 2018 Eurobond. The Kenyan government has completed the early buyback of the $1 billion 2018 Eurobond that was set to mature in February 2028, and this buyback has been financed with the issuance of a new Eurobond for $1.5 billion. This move is part of the Treasury's proactive debt management strategy that is aimed at smoothing out the country's debt maturity profile and avoiding the pressure of a large single bullet repayment on maturity. As mentioned, to finance the buyback of the existing $1 billion 2018 Eurobond, Kenya has issued yet another Eurobond for $1.5 billion. According to a statement from the Treasury Principal Secretary, this strategy of extending the maturity profile of external debt provides the country with fiscal breathing space, which refers to the government's capacity to continue spending without endangering its long-term financial stability. This buyback marks the third time in the last 2 years that the Kenya government has conducted an early buyback of a Eurobond, which is a strategy that involves refinancing upcoming maturities with new Eurobonds that have an even longer maturity period. However, whilst the refinancing helps to extend the maturity, it unfortunately comes at a higher cost for the government, as the new Eurobond has been split into 2 tranches, with the first tranche being a 7-year bond that matures in October 2033 with an interest rate at 7.875%, and the second tranche is a 12-year bond that matures in October 2038 with an interest rate at 8.80%. The weighted average interest rate for the new combined issuance comes out at 8.7%. This results in an annual debt servicing cost of $130.5 million, which is in contrast to the previous bond that had a lower interest rate of 7.25% and was costing the government $72.5 million per year in debt servicing costs. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, Please share it with your family and friends and also help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, there is nothing noble in being superior to your fellow man. True nobility is being superior to your former self. A quote by Ernest Hemingway. Think about it. Thank you, and God bless.